Hey guys, welcome to my YouTube channel. If you've not done so before, hit the subscribe button below and the like button. Hit the notification button as well. That way you get notifications on new videos coming soon. All right. In this video, I'll be talking about the beta of the stock. Okay. This is for those who want to know what kind of risk they're getting into. For those who are risk averse, don't want to get into too much risk, and those who like to get in a lot of risk, like the momentum strategy traders, which is a trend right now. Um, in this video, I will be showing you this right here. All right, I'll be showing you this right here. You look at the beta right here, right? I'll be showing you the beta, right? 1.21. This is for Apple. So this area right here is what I'm talking about, because you got, this is what I'm showing you, the beta, this portion right here, okay? There's many things people look at: the market cap, the P ratio, the earnings per share, all of those things. But in this one, beta, all right? If you did not know what beta is, I'm gonna break it down for you. I'm gonna break it down to you. I'm gonna give you a definition. I'm gonna tell you what it is, um, from 1 to 0 to -1, and then I'm gonna show you examples of how it looks in the market over the last 5 days, over the past 5 days, over the market, basically last week. All right, I want to show you what the beta, how it, I'm gonna tell you what it is, and show you examples from last week. Okay, so basically, beta is a measure of the volatility or systematic risk of a security or portfolio compared to the market as a whole. All right, that is used in the capital asset pricing model, which describes the relationship between systematic risk and expected return for assets, usually stocks. So the beta shows how correlated the stock is relative to a benchmark such as the S&P 500. All right, so beta of 1, this means that this is highly correlated to the S&P 500. You're going to see when the S&P goes up, it goes up with it. All right. A beta of 0, all right, means that the stock is not following the trend of the S&P 500. It's basically just doing its own thing. Okay, just doing its own thing. Period. It's not predictable. Okay, as you might think, some pharmaceuticals or oil companies, whatever, they might be closer to 0 because you probably just got to be in those industries to know what's going to happen next. You have to be literally in the office working to see. I got the news. I know what's going to happen. It's usually not readily available. The information is not readily available to know when it's going to go up and down. All right. So a beta of -1 means the stock is negatively correlated to the S&P 500. Okay. Um, so when the S&P 500 goes up, or the market goes up, right? This is our benchmark. When it goes up, this stock goes down. All right. So, quick example before I show you the real examples. If we look at the stock of we look at the beta of a stock that has 1.3 as its beta, this is 30% more volatile than the market. All right, this is not going to be in other videos saying that, but yes, it's a 30% more volatile. So when S&P 500 goes up, let's say 10%, it's going to go up 13% at the same time. So it's a little bit more risky. Some stocks are a little higher, but I'm gonna show you. All right, show you how this looks across different stocks. Okay, because you need to know this seriously. So you look at Apple. All right, this has a beta of 1.21%. All right, over the last 5 days. Now look at the S&P 500. All right, so this is going up, right? And this, so that means Apple should follow the same trend except slightly higher. Okay, so look at this. So boom, same trend because it's 1.2, so it's slightly more volatile market move. S&P goes up, it goes up. So boom, the next one. This one is slightly below the S&P 500, so it's gonna do just it's starting to do its own thing. Okay, so it's starting to go down just a little bit. All right, it's just kind of like a donkey. It really don't. It's a little stubborn. All right, starting to get stubborn. All right, so the Eli Lilly, boom, been close to 0. It's really just doing its own thing. Okay, we don't care what the market is doing, whether it's going up and down. We just doing us. You feel me? So you're gonna look at this. It's going up. down, up, and dramatic, and you see Eli Lilly just not giving a rip. Okay, we don't care. We just, it is what it is. All right, zero. Saying then this one, Dr. Reddy's laboratory. Listen, this is not. It's not a video that said to invest in these things. This is an example. All right, so boom. So 5 days, S&P 500. Look how it goes in the middle. You look at the middle of it. Um, the middle of the S&P 500 is going up, then down and up around here around June 10th, whatever. And June 10th is just not doing the same thing. It's not spiking because it just don't care. All right, zero. All right, so boom. Oh no, one of them is gone. Let's go back. All right, and this one is Gravity Company Limited. All right, this one has a negative beta. All right, we're opposing what the S&P 500 is doing over the last 5 days. So we're doing basically the opposite. So on the 10th, the S&P was going up. This was like not going spiking up around the 9th and the 10th time. So you can see this, and it's just not spiking up on the 10th like what the S&P 500 is doing. It's just not doing that. So this is good analysis. Okay, this is one of those things you probably been saying for a while and been saying like, what is beta? This is beta. It is the volatility of the market. All right, if you stay for this video, I'll show you the raw bones of what the beta is. Okay, but it's basically, if you continue on this video, it's the covariance over the variance of the market. All right, the covariance of the stock relative to the market S&P 500 over the variance. All right, so I'm show you this in a raw. I'm just show raw data, okay, on how this works. All right, and pull up my Excel and show you. All right, so boom. So boom. So this is for Google. Okay, this is the covariance and the variance of. This is the variance. So this variance will come from the S&P 500. All right. So it's 0.0000574,093. Okay. That's the variance of the S&P 500. All right. And this is the covariance. This is like the S&P 500 and Google multiplied together. All right. And then, long story short, when you divide the two, you will get this number 1.02. All right. Using all this data right here. All right. All right. So this is, if you put in Google, then you put in the returns of S&P 500, you get the returns, right? You get the returns by dividing this 334 by 332, you get your returns. You do the same thing for S&P 500. See, I'm gonna run through this just to show you that this is what's going on behind the scenes, but this is what's going on behind the scenes. All right, so, and then we break it down further and get Google, the return on Google divide minus the expected return on Google. All right, so the expected return on Google is the average return of all of these from top to bottom. All right, and S&P, we do the same thing. The return, which is the actual return, minus expected returns, average of all these, which you expect, and then this is what you get. You get this number, and then you continue on, and if you want a class on this, I would say sign up for a class to break this down. All right, so we're going to multiply the two variances, right? Which is the variance of Google, right? Which is basically the return of Google minus the expected return of Google times the return of S&P 500 minus the expected return of the S&P 500. So we're going to multiply those two divided by the variance of the S&P 500, and then we're going to get this. So you got the covariance divided by the variance equals the beta. All right. The covariance is S&P 500 times, as you see here, You multiply these two and you get that number. All right. So I summed it up here, but this is the bare bones. That's what you will see in the background. If you do want a further class on that, I say, there's a Udemy class you can take on this. All right. If you do want to take a class on Define Beta, just email me, okay, and I'll send it to you. But this is just to show you what, the back end of Beta. All right. So 1.02. So this the end result is 1.0299 for the beta of Google. All right. This is volatility compared to the S&P 500. All right. All right. Let's see. 1.02. Let's see what it is for Google. 1.02. That's after you do all the data and you do your due diligence. You'll get close to what even Yahoo Finance has. All right, guys. This is my YouTube video. If you liked it, subscribe, hit below. This was just purely informational. Just breaking down the S&P 500 and just showing you what's going on with beta. Showing you what the beta means when you're picking out stocks and stuff. All right, instead of just going around, don't know what's going on, and just picking stuff based off of hype. You can do your own research and say, all right, this is what's about to happen to me. You can tell what's about to happen to you because you know the beta. All right. So, all right, thank you for tuning in. Hit the subscribe button below, the notifications button below, so you can get more videos. All right, thank you. Have a good day. Be blessed. So